Swayam Prabha. Digital India. Educated India.
Hello everyone, this is a new lecture on Introduction to Mortgage Financing in the course Real Estate Finance and Investment Strategies. In this particular course and this particular class, basically we will be having the following learning objectives. So understand fundamental principles of mortgage financing in real estate. Then we'll identify and compare different types of mortgage loans in the Indian market. Calculate mortgage payments and analyze loan terms, evaluate the impact of interest rates on borrowing cost, and understand the mortgage approval process and qualification requirements. Apply mortgage financing concepts to real estate investment decisions. Now, what is mortgage financing? So, the basic concept of mortgage basically that we want to take some loan. Like for that loan, we have to mortgage something. So, real estate, when goes to, when somebody goes for bank, they or other housing loan authorities, so they like about to purchase some new property, then they mortgage that property, or if they have existing property, on the basis of that they take loan. So, that is the overall mortgage process which we understand. So, in terms of definition, mortgage financing is the process of obtaining a loan to purchase or refinance real estate with the property itself serving as collateral for the loan. So, if the property we are about to buy, so it will act as a collateral for that loan. Now, there are some key characteristics we have to understand about this. So, property serves as security and that is why this is a mortgage loan we are talking about. So, it becomes a collateral security, and in lieu of that we get the loan. Then long term financing generally is the characteristic of real estate related loan. So, long period of time is required for paying back the loan. Typically, we have around 50 to 30 years. Then regular periodic payments. So, in this loan payment is done periodically. Loan is basically divided into different parts and every month or a particular period, the borrower has to pay back that loan. And then interest, and we have a principal component, one which is the loan amount which we have taken, and then there is an interest which is levied and a portion of that. So, there are two components of this particular loan. And then legal documentation and registration, which is there in this loan process. That is, there is lot of papers which are required, lot of proofs are required. So, documentation, everything has to be done in proper process. Then, what is the importance of mortgage financing? So, first of all, affordability. So, that's a without mortgage, only the wealthy could purchase properties outright. Consider that a middle class family in Mumbai earning 15 lakhs annually could never buy a 1 crore apartment without financing. So, mortgage makes home ownership accessible to the broader population. Second, leverage is there. This is particularly important for investors. With leverage, you can control a 1 crore property with just 20 to 25 lakhs of your own money, potentially amplifying the returns. If the property appreciates by 10%, your return on invested capital could be 40% or more. So, that is one advantage. Then third, capital preservation. Instead of tying up all your liquid assets in one property, you can diversify investment while still participating in real estate. So, capital preservation, that is unique point here. Then tax benefits. So in India specifically, we have substantial benefits. So you can deduct up to 2 lakh annually on interest payment and 1.5 lakhs on principal repayment. Then fifth is your risk distribution. So a lender shares the risk by conducting thorough due diligence on both borrowers and properties. Finally, the economic impact is enormous. Mortgage financing drives construction activity, it creates employment, and it stimulates economic growth. So the multiplier effect means that every rupee of mortgage lending generates several rupees of economic activity. So that is how broad the importance of mortgage financing is. So it does not touch the affordability aspect, but it also touches the overall improvement in economics of a particular country. And also that there are some special features which are like specific to, let's say, India, that we have so many tax breaks which are available. So government is also encouraging home ownership. So overall, that is the importance of mortgage financing, how it is helping the growth of real estate in India. Then let's talk about Indian mortgage market overview. So the Indian mortgage market has experienced remarkable growth over the past 2 decades. The current market size of 24 lakh crores represent tremendous growth from just 3 to 4 lakh crores in early 2000. However, our mortgage to GDP ratio of 11% is still significantly lower than developed markets like the US, 80%, or even emerging markets like China, where it is around 20%. So this indicates substantial growth potential. The 15 to 18% annual growth rate reflects increasing urbanization, rising incomes, and growing awareness of home ownership benefits. Key drivers include demographic dividends. So India has a young population entering prime home buying age, rising nuclear family formation, and government initiatives are also there, like Pradhan Mantri Awas Yojana, which is basically helping out in this area. And overall, this particular area in India, we have a lot of regulations because it involves finance. So safeguarding the Indian consumers, the overall population, general population. So it is regulated, and the regulation are given by RBI and National Housing Bank. So they are providing proper rules and regulations under which all this is actually working. Then we have key market participants. So the mortgage ecosystem involves multiple participants. So we have borrowers. Borrowers are basically individuals, entities seeking financing for housing. In this case, it is the housing we are talking about. So housing related or other real estate assets, but that is borrowers who are going to bank for taking loan for purchase of home, or there are other types of housing or real estate related loans. We will see that, but borrowers are the one who go and seek loans. Then we have lenders, so banks, NBFC, that is non-banking financial corporations, and we have housing finance companies. So they are the ones who are lending here. So they basically help individuals by providing them loans for purchasing of real estate. And then we have intermediaries, which is mortgage brokers, consultants. So they act as a party between the banks, these lending institutions, and borrowers. And then we have support services. We have appraisers, legal advisors, insurance providers. So they are the ones who smoothen the overall process of taking loans from these entities by the borrowers. And so there are certain documents which are required for all this. Your credit worthiness, your property related papers, other important things, valuation of the properties, that are basically something which requires papers and every like documentation which is related to this. So support services are helping in that. And then of course regulators, which we just discussed that RBI, NHB, government agencies are controlling overall scheme of things here. Then we move to classification by interest rate. So interest rate structure represent the most fundamental classification of mortgage loans. Fixed rate mortgage provide complete predictability. That is one type of mortgage which can be availed. So your EMI remains constant throughout the loan term. This is particularly valuable when interest rates are low and expected to rise. So we have predictable EMI payments, right? However, fixed rate loan is in India typically carries high initial rates and are often available only for shorter term. True fixed rate products are less common here compared to Western markets. Floating rate mortgage, also called variable or adjustable rate loans, fluctuate with market condition. Since RBI mandate external benchmark linking in 2019, most floating rate loans now adjust automatically when policy rates change. This provides more transparency than the earlier base rate system. So the initial rates are typically lower, making loans more affordable initially. However, borrowers bear interest rate risk. If rate rise substantially, EMIs can become unaffordable. Then we also have hybrid mortgages, which attempts to balance these trade-offs by offering an initial fixed period followed by floating rates. So this provides initial payment stability. And while allowing borrowers to benefit from potential rate decrease later. So the choice between these structures should align with borrowers' risk tolerance, income stability, and market outlook. Then we move on to fixed versus floating rate comparison. So this comparison table, basically, which you can see here, is highlight the key trade-offs between fixed and floating rate mortgages. The rate level difference is significant. Floating rates are typically 1 to 2% lower initially, which can mean substantial EMI savings. For example, on a 50 lakh loan, a 1% rate difference translates to about 4,000 lower monthly EMI. So you can understand the level of difference which can happen. And then we have payment predictability favors the fixed rate, which is budgeting becomes easier when you know exactly what you will pay each month for the next 15-20 years. So payment predictability, consistent EMI is then the feature of fixed rate, and it is variable for floating. Of course, it is not fixed. And interest rate risk allocation is the core difference. With fixed rates, the lender bear the risk of rate changes. So borrower is kind of protected here. You know exactly at what rate you are getting, and you will constantly remain at that rate. So there is a benefit of this to borrower, that they are paying a specified rate, and throughout the period of the loan term, it will remain same. Whereas in floating, that is not the case. In floating, the rates can fluctuate. It can change from, according to the market conditions. It will change according to the policy given by regulatory authorities. It can change. So it's not fixed, and the main risk here is by borrowers, because borrowers bears risk here in this particular case. Then we have prepayment. So for prepayment, we have to understand that this is prepayment terms heavily favors floating rates. So RBI regulation prohibit prepayment penalties on floating rate home loan. Okay, so while fixed rate loan may carry 1 to 2% penalties, but the free floating rate home will not have any penalty as such. So the decision framework should consider current rate environment. If rates are historically low and likely to rise, fixed rate makes sense. If rates are high and expected to fall, floating rates are preferable. Personal factors like income stability and risk tolerance also matter significantly. So that is there. So best case scenarios, if you compare, of course, rates when are expected to rise, fixed rates are best, and when rates are expected to fall, floating rates are better in comparison to fixed rate, because they are about to fall. So you will have the benefit of that. So that kind of difference we can clearly see between fixed versus floating rate comparison. Then coming to classification by loan purpose. So we have home purchase loans, most common, favorable terms. So generally housing finance, there are the companies which we discussed, housing finance companies. So by like the name suggests, mostly you will see that home loans are there, most common. And because these are being availed by first time homeowners, people who want to purchase home for living their lives, it's not for investment purpose, it is for their living purpose. So government also provides lot of incentives, benefits, whether in the form of some schemes or whether in the forms of tax benefits. So they are provided, and similarly mortgage loans also are much more affordable in comparison to other form of loans. Then we have home construction loans, which is staged disbursement according to the level of stage of construction. This kind of loan can also be availed. Then we have home improvement loans for renovation and upgradation. So if there is any home improvement, there is a renovation, often carrying higher rates due to lack of additional security. So that kind of loan is also there. Then we also have land purchase loans, which carry higher risk because land doesn't generate income and may be illiquid. So LTV ratios are 60 to 70%. LTV, that is loan to value ratio. So it is lower, 60 to 70%, and rates are higher in these cases. Commercial property loans have completely different risk profile, and considering business cash flow and property income potential, they are decided. So understanding these different type of loans helps borrowers choose appropriate products and lender assess application correctly. Then we have classification by repayment structure. So repayment structure significantly impacts the cash flow and total borrowing cost. Standard EMI is most common, equal payments throughout the loan term with early payment predominantly interest and later payment predominantly principal. This amortization schedule is mathematically derived to ensure full loan repayment. The EMI formulas I have shown is fundamental. You must understand this calculation, this particular formula, right? So the EMI formula here is very fundamental, and calculation as it appears in every mortgage analysis. So let me go through this. So P is principal amount here, and R is your monthly interest rate, annual rate divided by 12, and N is total number of monthly payments. Then step up EMI suits young professionals expecting income growth, that is the step up EMI is the second type. So initial EMIs might be 80% of standard EMIs, increase to 120% later. This reduces initial payment burden but increases total interest cost. Then we have balloon payment loans, features lower periodic payment with the larger final payment, perhaps 20 to 30% of original principal. These suits investors expecting significant property appreciation or refinancing opportunities. So they will go for this. These suit investors expecting significant property appreciation or refinancing opportunities. Then interest only loans are rare in India, but allowing paying only interest initially with principal amortization beginning later. So these are extremely cash flow friendly initially, but result in much higher total cost and are typically available only for high net worth borrowers or commercial properties. Then moving on, we have one example here of EMI calculation. So let's see. So this calculation is step by step. Let's analyze this. So we start with 50 lakhs principal amount. The actual loan amount after down payment is there, and then the annual interest rate of 8.5%. Then we have tenure, which is of 20 years, and we have a monthly rate. So 8.5 divided by 12, we get this. Then the 20-year tenure becomes 240 monthly payments. Now applying the formula which we had seen earlier, we can get, or if we put all the values, we get EMI of 43,391. So the constant EMI for a standard mortgage, that is this. So in the first year, annual payment of we are making of 5,20,694, which has interest component of 4,25,000, which is 85% of the payment. And then we have a principal component of 95,694, 15% of the payment. So this means 85% of first year payment goes towards interest and only 15% towards principal reduction. This interest heavy split early in the loan explains why prepayment are effective in reducing the total interest cost. Understanding this calculation will help to verify lender quotations and analyze scenarios. Right. Now let's see impact of loan term. So this table dramatically illustrates tenure's impact on borrowing cost. Notice how EMI decrease as tenure increases from 62,671 for 10 years to just 38. In the 10th year we have this, and in for 10 years we have this, and for 30 years we have EMI of 38,422. Now this seems attractive when you just look at this side. It seems attractive, but look at the total interest cost. So now when we look at this side, when we look at the total interest cost, it increases from 25.2 lakhs for 10 years to 88.3 lakhs. The 30-year loan cost more than 3 times the interest of the 10-year loan. The interest as percentage of principal column is particularly revealing. For a 30-year loan, you pay 17.6% of the principal amount as interest. This means you effectively pay for the property nearly 3 times over. The lesson which we get is clear. Longer tenure reduces monthly burden. It reduces the monthly burden, but dramatically increases the total cost. The decision should balance current cash flow constraints against long-term cost implications. So many borrowers start with longer tenure for affordability, then make prepayments to reduce the effective tenure. This strategy provides flexibility while minimizing initial total cost. For investment properties, the decision becomes more complex as you must consider rental income, you must consider the tax benefits, and you can also consider alternative investment opportunities for the EMI savings from the longer tenure. Then we have special borrower categories. So we have different borrower categories receiving different treatment, reflecting varying risk profiles. So residential home loans for self-occupied properties get the best terms. So we understand that bulk of the loans, when we are talking about home loans, we are talking about these residential home loans. The tax advantages, the tax benefits given by government are also for the residential home loans. So this is the very big category, very big class of borrowers which are there. So of course, accordingly, the targeted home, these loan products are also one of the biggest size. Then we also have investment property loans. So investment property loans, as the name suggests, are for the property loans which are basically for the investment purpose. So rate typically 0.5 to 1% above residential rates, because investors may walk away more easily during market downturns. There is no emotional bonding here, which is the case of residential home loans. Lender also consider potential rental income in qualification calculations. Now, NRI home loans are also there, which serve non-resident Indians investing in Indian real estate. These loans require additional documentation like passport copies, visa status, and foreign income verification. Currency fluctuation creates additional complexity. Some loans are rupee denominated while others are in foreign currency. Repayment typically occurs through NRE or NRO accounts. Then we have MSME loans, combine business lending with real estate financing. So lenders evaluate both business financial and property value. These loans often include business performance covenants and may require personal guarantee from business owners. Understanding these categories help borrowers approach appropriate lenders and set realistic expectations for the terms and requirements. Then we move to government schemes, which is PMAY. So, Pradhan Mantri Awas Yojana represents the government's commitment to affordable housing. So, the government provides substantial interest subsidies based on income categories. EWS LIG up to 6 lakhs income receives 6.5% interest subsidy, effectively reducing their borrowing cost significantly. Then we have MIG1 category covering 6 to 12 lakh annual income, get 4% subsidy, while we have MIG2 covering 12 to 18 lakh gets around 3% interest subsidy. Now, let's explain this example which is given. So, for an EWS borrower, right, taking a 6 lakh loan at the rate of 8.5%, the standard EMI would be 5,207. With the 6.5% subsidy, the effective rate becomes 2%, reducing EMI to 3,021. This 2,186 monthly saving translates to we have post subsidy EMI, which is only of 3,021. So, this lifetime saving will be approximately 5.25 lakhs. So, the scheme has specific conditions. We have property size limits, income certification requirements, and beneficiary must not own any other property, because it is for the first time, house owners, this scheme is being given. So, there is a condition that this is for residential purposes, for basically giving home to a family. So, that is the reason that if somebody already owns a house, this scheme will not be applicable to them, and this is for the first time homeowners. Then we have this scheme has improved housing affordability for middle and lower income groups. However, benefits are available only for new purchases, not refinancing, and only through approved lenders. So, understanding these schemes helps borrowers maximize the available benefits and plan their property purchases accordingly. Then, understanding interest rate. So, we have to interest rate determination has become more transparent since RBI's external benchmark mandate. Every loan rate now consists of two components. One is your benchmark rate plus spread. So, the benchmark rate is typically the repo rate linked lending rate, that is known as your RLLR, which automatically adjusts when RBI changes the repo rate. Some lenders use treasury bill rates or certificate of deposit rates as benchmark. The spread represents the lender's margin, covering their cost of funds, operating expense, risk premium, and profits. This spread varies significantly based on borrower's profile. A salaried employee with excellent credit score might get a spread of 1.5%, while self-employed borrower with average credit might pay 3% spread on the other same benchmark. The beauty of this system is transparency. When RBI cuts repo rate by 0.25%, your floating rates automatically decreases, right? And by the same amount. So previously under the base rate system, transmission was opaque and often incomplete. The spread also reflects loan characteristics, higher LTV ratio, longer tenure, or riskier property types command higher spreads. So understanding this structure helps borrower negotiate better terms and choose appropriate lenders. It also explains why rates vary significantly between lenders for similar borrower profile. Then coming to the factors affecting interest rate. So there are certain macroeconomic factors. So we have RBI monetary policy, RBI deciding the interest rate, repo rate. So periodically RBI meets and they decide on the interest rate, and these rates are then shared with the general population, that what RBI has decided. So that is one important factor which impacts the interest rates which are there for the mortgage related financing. Then we also have inflation rate, which is there, so which is playing a crucial role. So inflation rate is there. Then inflation rate basically that is whether particular what is the current inflation rate, that decides a lot on the businesses and everything, because typically it is related to purchasing power of people. So that is there. Then the economic growth, which is there. So economic growth of the country, the GDP and everything, that impacts the interest rate, overall business environment. And then global economic conditions also plays a crucial role, because we have seen in past that in major recession and bigger events such as that, that lead to such type of situations. So that is there. Then we have lender specific factors. So we have cost of funds, what are basically from where you are taking the loan. So that plays a crucial role. So for example, public sector bank often have lower cost of funds due to large deposit basis, but may have higher operating cost. Private banks might offer competitive rates to gain market share. NBFCs typically charge higher rates due to their own higher borrowing cost. A lender rate risk appetite varies with their capital position and growth strategy. So during stress period, even good borrowers might face higher rates as lender become risk averse. So borrower specific factors create the most variation. CIBIL scores above 750 typically qualify for best rates, while scores below 650 might face rejection or premium pricing. So employment stability matters. Government employee often get preferential rate. The loan amount also matters. Large loan might qualify for relationship pricing, while very small loan might carry higher processing cost per rupee. So that is there. Then we come to loan to value guidelines. So LTV guidelines represent RBI's approach to managing system risk in the banking system. The tiered structure reflect risk assessment. Here we can see that smaller loans receive higher LTV, right? Here you can see that they are getting higher LTV, that is loan to value ratio. You can avail 90% of this value. Similarly, this drops to 80% for loan between 30 to 75 lakhs. And when the loan amount is even bigger, 75 lakh, the maximum LTV is 75%. So that is there. So special categories have lower LTV reflecting higher risk profile. So we have these special categories also. You can see that for commercial properties, it is 65 to 75%. For land purchase, it is 60 to 70%. NRI loan, basically maximum 80%. So the idea here is that the RBI is trying to safeguard the overall both the institutions, because many times banks are public owned, or even if they are private owned, they are there is a problem, there is a issue of fudging and everything. So that is one area of concern. Also, the idea is that the lower ticket size loans are being taken by general population, and their affordability is already constrained. So for first time buyers of home, they are encouraged by government. So that is why there is a maximum LTV ratio. And for the riskier propositions, we can see that this LTV has lower level of limit of, say for example, commercial properties, which has only 65 to 75%. Then we come to effective interest rate concept. So here the stated interest rate often understates the true cost of borrowing due to additional fees and charges. Processing fees, typically 0.5 to 1% of loan amount, represent significant upfront cost. For a 50 lakh loan, even 0.5% processing fee means 25,000 additional cost. So documentation charges, appraisal fees, legal charges, and insurance premium add further cost. The annual percentage rate APR attempts to capture these total costs in single number. In our example, an 8.5% stated rate becomes approximately 8.65% APR when including a 0.5% processing fees. We have pre-EMI interest, which deserves special attention for under construction properties. During construction, you pay interest. Only on disbursed amount, but this can accurately, this also can go on increasing substantially. So for a 50 lakh loan for a property taking 3 years to complete, pre-EMI interest might total 4 to 5 lakhs. Some lenders add this to the principal amount, increasing your effective loan size. Other allow separate payment during construction. So understanding effective rates help in true cost comparison between lenders. A loan with lower stated rate but higher processing fees might actually cost more than a higher rate loan with a minimal fees. So always calculate APR when comparing options. So also consider the tax treatment of various costs. Some charges might be tax deductible while others aren't. Then we move to prepayment strategies. So prepayment represent one of the most powerful tools for reducing borrowing cost. So RBI prohibition of prepayment penalties on floating rate home loans makes the strategy particularly attractive. The example which is shown here, it highlights the dramatic saving potential. So annual prepayment of just 1 lakh on a 50 lakh loan can save 12 lakh in interest cost, right? So this occurs because early prepayment directly reduces principal, eliminating future interest rate on that amount. The power of compounding works in reverse here. There are 3 main prepayment strategies. Regular partial prepayment involves making additional payments alongside your EMI. Even 5,000 extra monthly can significantly reduce tenure and interest cost. Then EMI increase strategy involves voluntarily stepping up your EMI, perhaps when you receive salary increase. This requires less active management than irregular prepayments. Then we have lump sum prepayment use windfalls like bonuses, inheritance or investment gains. So that can be done. However, prepayment decisions aren't always optimal. You must consider opportunity cost. Could you earn more than your loan interest rate through alternative investment? So tax implication also matter. Losing interest deductions benefits might offer some savings. So for investment properties, prepayment eliminates leverage benefits. The decision requires balancing guaranteed savings from prepayment against potential returns from alternative investment, considering your risk tolerance and tax situation. Then we go to mortgage qualification criteria. So mortgage qualification has become increasingly standardized, though nuisance remains between lenders. Nuances such as income assessment focuses on stability and adequacy. Debt to income ratio, typically capped 40 to 50% of gross income, ensures borrower aren't over leveraged. This includes the proposed mortgage payment plus existing EMI, credit card payments, and other obligations. Lender verify income through salary certifications, right? And then we have bank statements, tax returns. Self-employed borrowers face additional scrutiny, often requiring longer income history and higher documentation standards. Credit evaluation centers on CIBIL scores, which ranges from 300 to 900. So score above 750 typically qualify for best rates and terms. Scores between 650 to 750 might qualify with higher rates or lower LTV. Below 650 often leads to rejection or requires substantial compensation. Factors like higher down payment or co-applicants. So repayment history matters beyond just scores. Lenders examine patterns of past borrowing and repayment behavior. Property evaluation involves technical, legal, and financial assessment. Technical evaluation confirms structure integrity and compliance with building codes. Legal evaluation ensures clear title, proper approval, and compliance with local regulations. Financial evaluation determines market value through comparable sales or income approaches. The property must meet minimum value threshold and marketability standards. Understanding these criteria helps borrowers prepare application effectively and choose appropriate properties. Then we move to documentation required. So documentation requirements, we can see here that we have discussed. First, we have income documents. So salary certificates and pay slips of the salaried class. For income, you have income tax returns and financials for the self-employed. So like we discussed that there is a big list of documents required for self-employed. For salaried, it is easier. And then we have bank statements which are required for 6 to 12 months of the past. And then property documents. This is very important that the property is owned, being owned by the person, or the person who is selling, like there is no issue. So that kind of thing also is verified. So sale agreement, allotment letter, if there is a government allocated property to a particular individual, so allocation letter has to be there, this allotment letter has to be there. Then title documents, the name on which the property is. Then approved building plans, the plans for building are approved by the local development authority. And then property tax receipts are there, property tax has been paid regularly. And then personal documents such as identify and the identification of that person, their address proof, age verification, and photographs and all that. So basically a long list of documentation is required by the lending bodies. Then we have insurance requirement. So we have mandatory coverage, property insurance, cover structure against fire and natural disasters. Amount typically equals loan value. Lender named as interested party here. So some mandatory coverages. And then mortgage redemption insurance. So term life insurance covering loan balance, insurance loan repayment upon borrower's death, and premium may be added to loan amount. So we understand these now. So insurance requirements, they protect both borrowers and lender interest. Property insurance covers the physical structure against fire, natural disaster, theft, and other specified perils. The coverage amount typically equals or exceeds the loan amount, ensuring the lender's security isn't compromised with the property damage. Lender is named as interest party, meaning they are notified of any claims or policy changes. Insurance is mandatory throughout the loan term, and premiums can often be added to the loan amount. Mortgage redemption insurance, also called loan protection insurance, is essentially term life insurance covering the outstanding loan balance. So if the borrower dies during the loan term, this insurance pays off the remaining loan, protecting the family from losing the property. So the coverage amount decreases with the loan balance, makes it relatively affordable. Premiums can be paid annually or added to loan amount. Some lenders require the insurance, while others make it optional but strongly recommended. So home contents insurance covers personal belongings within the property, furniture, electronic, jewelry, etc., while not directly related to mortgage. Lenders often offer this as a bundled product at discount rates. Understanding insurance requirements helps borrower budget for total home ownership cost and ensures adequate protection for their investment. Then we move on to leverage in real estate. So we understand that leverage ratio is total property value divided by equity investment. So property value of 1 crore, loan amount is 75 lakh, equity investment, the person is paying 25 lakhs, loan is of 75 lakhs. So leverage ratio here is 4:1. So impact on return, 10% property appreciation is equal to 40% return on the equity. So the person who is investing here is paying 25 lakhs, 75 lakhs is coming from the bank, and so the overall then 1 crore house is there, and for that property the person who is owning that house has put in only 25 lakhs. So if there is any appreciation in the prices, it will be like for example 10% property appreciation, 40% will be the return on the equity for somebody who is only putting 25 lakhs. So then there is another aspect of tax benefits in India. So we can understand tax benefits make Indian home loan particularly attractive compared to many other countries. Section 24B allows interest deduction with different limits for different property users. For self-occupied properties, you can deduct up to 2 lakh annually on interest payment. For let-out properties, there is no limit on interest deduction. You can deduct the entire annual interest against rental income. This makes investment properties more attractive from tax perspective. Section 80C allows principal payment deduction up to 1.5 lakh annually. Combined with other 80C investment like ELSS, PPF, NSE, etc., most borrowers can utilize this full limit through home loan principal payments. Section 80E provides an additional 50,000 interest deduction for first-time home buyers subject to specific conditions like property value limits and borrower income threshold. The combined benefit can be substantial. A borrower in the 30% tax bracket saving around 2.5 lakhs in annual deduction and saves 75,000 in taxes. However, these benefits have conditions. Self-occupied property benefits are available only if you don't receive any rental income. The property must be in your name or jointly owned. Construction period interest can be claimed in 5 equal installments starting from the completion year. Now, understanding these nuances help maximize tax benefits and influence decisions about property type, loan structure and ownership patterns. Then we move on to a practical example here, that how this annual tax saving is happening. So you can see for 30% bracket, interest deduction is of 60,000 and principal deduction is of 30,000 for 50 lakh loan. So that is a substantial amount of tax saving which we are getting. So we can understand how big this can be. Then we have DSCR for investment properties. So debt service coverage ratio formula, which is net operating income divided by annual debt service. So acceptable DSCR for this is commercial properties is minimum 1.2 to 1.3. For residential rentals, it is minimum 1.0 to 1.1. So example will be annual rental income of 6 lakhs, operating expense 1.2 lakhs. So NOI would be 4.8 lakh. So annual debt service will be 10.7 lakhs. And this leads to DSCR of 0.545, which is below acceptable threshold, because we have seen that for For this residential, we have this 1.0 to 1.11. Then interest rate sensitivity analysis. So impact of 1% rate increase, 50 lakh loan, originally 8.5% for 20 years. Option 1, keep EMI constant. So original tenure is of 20 years, new tenure is 23 years, 10 months. So additional tenure of 3 years, 10 months, that is there. Then option 2, keep tenure constant, original EMI of 43,391 and the new EMI is 47,702. So EMI increase of, we have 4,311 we can see here. Then we come to mortgage market trends. So current developments which we can see, external benchmark linking, repo rate is done, digital processing and approvals have been introduced, reduced documentation requirements are now there, competitive interest rate environment is there, and government affordable housing initiatives such as PMAY has also been brought. Future outlook, if we can talk about that. So continued market growth, technology adoptions, new and newer technologies are being included in this whole process, and then regulatory refinement which are taking place. Regulations are being improved on the basis of feedbacks from stakeholders, and then increased institutional participation will keep on happening. So these things are continuously happening in Indian real estate market and lending market of mortgage related products. So these will constantly improve. Now key decision factors here would be the interest rate type, whether you are going for fixed versus floating based on rate outlook, loan tenure, balance between EMI affordability and total interest cost, lender selection, compare rates. We have to compare different rates which they are offering, service quality, terms. So we have seen that even the processing charges are also very important. So lender selection plays a crucial role. Prepayment strategy you have to make, when we have to prepay, how much we have to prepay. So that strategy can help us in reducing our loan cost, and tax optimization. So maximum available deductions we can make, and that can also help us in key decision factors here. So summary and key takeaways. So mortgage financing enables property ownership through leverage. Interest rate choices depends on market outlook and risk tolerance. Loan tenure significantly impacts total borrowing cost. Tax benefits substantially reduce effective borrowing cost. Prepayment can generate significant interest saving. Qualification requires stable income, good credit and proper documentation. We have seen the example of government employees. And then DSCR analysis is essential for investment property financing. So these are some important points which you should remember. You should think about how do current interest rate trend affect mortgage decisions, what role should leverage play in real estate investment strategy, how can borrowers optimize their mortgage terms over time, what impact do government policies have on mortgage accessibility, how should investor evaluate debt service capabilities for rental properties. With this, I conclude this session. Thank you.